to the token. Welcome to the Tokenized Money and Stablecoins in Africa webinar. My name is Hugo Coelho. I'm Director of Policy and Advisory at Financial Innovation for Impact. It is a pleasure to be moderating today's discussion. Africa's payment landscape remains highly fragmented, with high remittance costs and constrained inter-African trade settlement. It is against this backdrop that digital assets are increasingly being used across the continent, and regulators are responding to that increased use. Today's session brings together central bankers, regulators from across the continent, representatives of the industry, and researchers to discuss where the market is heading towards, how regulators can and should respond, and what industry and regulators can do together to leverage this technology and to take advantage of this market for regional integration and to support cross-border trade and transactions. This webinar is co-organized with the African Fintech Network and the UN Economic Commission for Africa. So before we begin, I would like to invite Afwork from UNECA to give some opening remarks. Afwork, if you're around, the floor is yours.
Thank you, Rob. Greetings all. Good afternoon, distinguished speakers, colleagues, partners, ladies and gentlemen. It is my pleasure to welcome you to today's webinar on tokenized money and stablecoins in Africa, cross-border payments, local currency stablecoins, and regulatory pathways for the continent's digital monetary future. On behalf of the United Nations Economic Commission for Africa, I would like to thank our partners, the African Fintech Network, Financial Innovation for Impact, and the Cambridge Center for Alternative Finance, and warmly welcome our distinguished speakers and participants. This conversation comes at a critical moment for Africa's digital financial transformation. Africa is no longer simply exploring digital assets. The continent has more than 54 million digital asset users, with Nigeria alone estimated to have around 25.9 million users. Nigeria is also among the world's leading markets for stablecoins adoption, with stablecoins increasingly being used for practical purposes such as cross-border transfers and access to dollar-denominated liquidity. This rapid adoption presents both an opportunity and a policy challenge. On one hand, tokenized money and stablecoins could contribute to faster, more efficient cross-border payments, support financial inclusion, and facilitate greater participation in Africa's digital economy. On the other hand, they raise important questions around consumer protection, financial stability, monetary sovereignty, regulation, and regional interoperability. For Africa, therefore, the question is not whether these technologies are emerging, but how we can shape their development to support our broader objectives of financial inclusion, regional integration, and digital trade, while addressing risks around consumer protection, financial stability, and monetary sovereignty. Distinguished participants of this webinar, this is closely related or aligned with ECS work on fintech, digital trade, and regional integration. A recent example is the Mauritius National Fintech Strategy 2026-2030, developed with technical support from ECA. The strategy seeks to create an enabling environment for responsible fintech innovation, with a focus on regulation, digital infrastructure, skills, market development, international collaboration, financial inclusion, and consumer protection. At the continental level, we are also looking at how emerging digital financial technologies can support the African Continental Free Trade Area, regional integration, and intra-African trade. This includes thinking about how tokenized money and local currency digital instruments can interact with existing continental payment infrastructure such as PAPs, and also and how digital trade platforms can connect more seamlessly with emerging payment solutions. Ultimately, our shared objective today is to ensure that innovation directly translates into more efficient, inclusive, secure, and interconnected financial systems, all while safeguarding monetary and financial stability. I look forward to a rich and practical discussion today. Thank you once again for joining us, and I wish you all a very productive webinar. Thank you.
We thank you for taking the time to speak to us today. Very grateful for that. On this note, allow me to welcome and introduce our speakers. In alphabetical order, Abdullah Mukalet from Senior Policy Manager at Ripple. Then is Kizito, Director Market Supervision at the Capital Market Authority of Uganda. Gillian Darko, Group Vice President of Strategy, Yellow Card. Ivo Jenik, Senior Financial Sector Specialist from CGAP. Tahiro Halassan, Head, Oversight and Compliance of the Virtual Assets Department of the Bank of Ghana. And last but not least, Visham Kusi from the Financial Services Commission of Mauritius. I'm pretty sure I've misread some of the names, and apologies for that. The discussion is going to be structured in three parts. We'll review market developments first, then we'll focus on the regulation in infrastructure, and finally, we will have an exchange about research opportunities and stakeholder engagement and collaboration. After the panel, if time allows, and I'll be very strict in timekeeping to allow for that, we will open the floor for some questions from the audience. Please feel free to share your questions in the chat, and I'll collect them and pose them to the speakers. To inform the conversation, we have invited Roman Proskalovic, a researcher from the Cambridge Center for Alternative Finance, to share the findings of a recent research paper that Roman co-authored on tokenized money, use cases, interoperability, and regulation. So I'll hand over the floor to Roman, who's going to speak for 10-15 minutes before we start the discussion proper. Roman, the floor is yours.
Thank you very much, Hugo. It's a pleasure to be here. Thank you for inviting me. Today, I would like to speak about our recent report, as Hugo just mentioned, called Tokenized Money, Use Cases, Interoperability, and Regulation. And the name is long, and for a reason, it doesn't have stablecoins inside. We believe that the landscape has evolved over the past couple of years, and the story is not only about stablecoins anymore. That's why in this report, we tried to understand how different tokenized money instruments are competing and complementing each other. And today I would like to share some of the key insights. And to start, to give you an overview of what we have done, I would like to mention the following. So our methodology was based on interviews with some of the key stakeholders in the ecosystem, including banks like JP Morgan and Standard Chartered, infrastructure providers like Visa, MasterCard, and Swift, or stablecoin issuers, including Circle, as well as regulators in jurisdictions that have advanced in regulation of tokenized money, for instance, from European Union, Hong Kong, Singapore, and the United States. Within our report, we were trying to achieve a couple of goals. One of them was to understand how these emerging tokenized money instruments are being used, what are some of the enablers and challenges for their adoption, and whether regulation is keeping the pace with innovation, ensuring consumer protection and growth of the innovation. But the first thing that we realized is that there is no common taxonomy to describe tokenized money landscape. that is consistent, coherent, comprehensive, and provides a clear delineation between different tokenized money instruments. So that was the first thing that we wanted to introduce within our report, and that we believe is very important for regulation as well, of course. The table is very complex, and I will share a link to the report itself in the chart after the presentation. For now, I just wanted to focus on the most important things, which are in the first column, where you can see 4 dimensions that, in our opinion, can help delineate between different tokenized money instruments. And these dimensions are claim, or what is a promise of a tokenized money instrument, backing of the claim, or what supports this promise, the form of the instrument. Here we mean whether it is issued natively on a distributed ledger technology platform, or it's just a representation of what is happening off-chain, and access, implying details of what limitations exist for the usage of an instrument. And using these 4 dimensions, we came up with 4 main categories or 4 main types of tokenized money instruments. Some of them are pretty familiar, like central bank money or commercial bank deposits on distributed ledger, but some are not so common, at least so far. For example, we suggest to distinguish between different forms of stablecoins and actually go away from usage of this term, because it was good when stablecoins were compared to cryptocurrencies like Bitcoin and Ethereum, but doesn't make that much sense when you compare that to more conventional money instruments, even when they are issued on a distributed ledger. So what we suggest is introducing a prepaid fiat representations label, or for short, tokenized fiat, which would be a way to call fiat-backed and fiat-pegged stablecoins, which is the most common and widely adopted tokenized money instrument so far. The last category you can see on this slide is called fiat anchored asset positions. Again, a long name, but we also have short versions for that. And it's kind of catch-all category that includes instruments that are commonly known as crypto-collateralized stablecoins, algorithmic stablecoins, tokenized money market funds, some novel projects that are called yield coins, and other instruments. A distinguishing feature of which is that they don't promise a one-to-one redemption, like, for example, fiat tokens or fiat stablecoins, but rather a claim on the underlying assets, a proportional interest in the portfolio, collateral, or something of that type. Our taxonomy has 2 layers. The first layer, you can see it on the slide. Second layer goes into further details, which are not critical to distinguish between money instruments, but important when you are developing a regulation or try to understand potential and limitations of usage of a particular instrument. This feature can vary for the same instrument over time or across jurisdictions, so they are more of interest just to analyze and understand in detail what a particular project has in mind. And these features include technical architecture, like type of ledger used, finality arrangement or privacy arrangement, legal and governance features, for instance, whether there are any transfer controls and what are transparency and disclosure rules, and business and economic models, for instance, where an instrument has yield for the users and what fees are implied. So with this taxonomy, we believe it is much easier to differentiate between different types of instruments and also develop a regulation that is fit for purpose and addresses all the peculiarities of the varying and ever-evolving instruments in the tokenized money landscape. We also analyze the market using this taxonomy, and what we see is that tokenized money market was more than 300 billion in 2025. Fiat tokens or prepared fiat representations or claims was the most important segment, with more than 250 billion in supply. But there are also other segments that are becoming increasingly more important, especially when it comes to commercial bank deposits in their tokenized form, with projects like JPM coin facilitating more than 2 billion in US dollars transactions daily. Some other significant segments are fiat anchored positions, including fund claims and collateral claims, each representing more than 10 billion in supply. As a parallel to our report, we are also developing a digital tool that is publicly available, and I will also share a link in the chart, that helps users understand the patterns of usage of stablecoins, including tokenized fiat tokens and also other tokenized money instruments across jurisdictions. So here, for example, you can see the shares that different countries have in global fiat and collateral tokens. And with help of this tool, you can explore data for individual countries. Like, for example, check a share of stablecoin flows in South Africa or Nigeria or other countries, not only in Africa, but globally. Beyond the taxonomy, obviously, we were trying to understand how these different instruments are being used. The focus was on stablecoins or fiat tokens, but other instruments were also considered. And when we spoke to private sector institutions, including major banks, infrastructure providers, and challengers like stablecoin issuers, what we observed that for all of them, at least within our sample, tokenized money is already a strategic priority. And what is also very important, they are ready to start the implementation of this strategic priority. For fintechs and challengers, this was most representative, where almost all of them ranked both priority and readiness level close to 10. For traditional banks, it was less so, with more variance, but for infrastructure providers, it was also the case to a very significant extent. And one of the drivers that we observed when speaking to interviewees is that fear of missing out is one of the potential motivations to implement tokenized money instruments at scale already starting now. And they do that for various use cases that you can see on the screen right now. Cross-border payments and real-time settlement was among the most important use cases mentioned almost in every interview. Other use cases included treasury and liquidity management, where thanks to 24/7 availability, companies, especially those doing cross-border businesses, can use their money in a most efficient way, moving it when it is needed and allocating it to get the yield and interest when it is possible. Other two emerging use cases were related to trade finance, digitization, and capital markets infrastructure. What was common for these two use cases is that tokenized money was the necessary prerequisite for further development of this digital trade finance and capital markets. It was serving as a settlement leg, and there was a vicious circle mentioned by many participants where the more tokenized money becomes available and user-friendly, the more it can serve trade finance and capital markets infrastructure, and vice versa. As these markets develop, the demand for tokenized money increases. Among key challenges that we explored together with interviewees, one of the most important was interoperability. And actually, it has multiple dimensions. It's not only about interoperability between the same type of instrument, like stablecoins or fiat tokens. It's cross-asset, cross-platform, cross-border alignment that is needed, as well as regulatory and governance coordination. So we should be able to switch between stablecoins, tokenized deposits across different issuers, and as governance of the projects that are doing tokenized money right now, including those from BAS, for example, are becoming increasingly complex. That dimension is also extremely important. Regulatory alignment probably being among one of the most important at the same time. When we were asking our interviewees about the importance of interoperability, almost all of them ranked it close to 9 or 10, with banks being the only exception. And that's basically due to one of the respondents who mentioned that lack of interoperability can also provide a business opportunity for traditional banks where they can be an intermediary solving the problem and getting a fee in exchange. While interoperability is one of the key challenges, programmability is one of the key enablers, allowing to get further features that are not common for traditional money instruments and facilitating many further use cases, including liquidity optimization, risk management, compliance, governance, control, etc., etc. Below, you see a quote from one of the interview participants who mentioned that programmability is something that allows trust between different organizations. And while automation usually happens within one organization, having programmability is a foundation to increase the scale of this process. After speaking to industry, we obviously also spoke with regulators, and we see some coherence here with regulators mentioning cross-border payments and remittances among the main use cases, while they still believe DeFi and trade for other crypto assets is another key use case. They also see future in other applications like wholesale settlement, domestic payments, treasury management that is already popular among industry representatives, and so on. And when we spoke with them about main risks that they see in tokenized money, not surprisingly, AML and safety concerns were among the most important ones. Other important risks included cybersecurity and operational resilience and financial stability, which in case of emerging jurisdictions also has a dimension of monetary sovereignty and competition with global payment means. Lastly, in our conversations with regulators, we spoke about effectiveness of the current regulatory regimes for tokenized money and primarily stablecoins and direction in which regulation is going globally. Just a reminder, we spoke with countries where there is already a regulation, one of the most advanced regulation for tokenized money, and even for them, effectiveness of the current regulation was not ranked at 5. Well, some did rank it that high, but on average it was closer to 3.5, 3.6, and ranged from 1 to 5. When it comes to direction of the global policy, whether it is divergent or if there are some common rules being developed, the situation is even more challenging with 3.1 on average, where 5 means maximum convergence and 1 is maximum divergence. There are already some recommendations from global bodies which we analyze in the report. And here we looked at IOSCO, BIS, FATF, and many others. What we see is that some dimensions like issuance of stablecoins are already covered, but other topics, including, for example, reserve requirements or treatment of overseas stablecoins and other tokenized money instruments, less so. We invite you to explore that in more detail in the report itself, and I will share the link immediately after the presentation, where you can also see the details about regulation in specific jurisdictions. But I hope these details are already sufficient to provide a global context for region-specific discussion that will follow right now. Thank you very much for attention. Hugo, back to you.
Thank you so much, Roman. Thank you for giving us the global overview. And I think that's very helpful now as we take a closer look at what is happening in the African continent and how these rules and global experiences can be inform and the discussion on how to come up with solutions that are tailored to the local realities. So as I mentioned before, we are dividing the discussion in 3 parts. We'll start with look at market developments. And I'll first go to Gillian from Yellow Card. So, Gillian, Yellow Card operates across more than 20 African countries, which gives you a very good overview of what is going on. When you think of use cases, which ones are the biggest by volume and which ones are growing at the fastest pace?
Yeah. Thank you so much for that question. I think what I'm going to do is to answer the question, I'm going to take you on a journey. So, yes, Yellow Card currently operates across 20 African countries. We've expanded into Latin, Asia, and the Middle East. And we actually started operations in 2019 in Nigeria. So, if you take your mind back on what was happening in Nigeria at that time, there was huge currency volatility, depreciation in the market. There was volatility as well. So what happened is we basically had a retail app where individuals could go onto that retail app and then were able to obviously purchase USDT, USDC from basically their local currency to that. Remember, the value proposition for stablecoins is really to hedge against the volatility in the market and to store that value. So over time, as the market has changed, we've seen different use cases. So we've moved more where you have an agricultural business, for instance, that wants to make invoice payments in the likes of India, where they're utilizing stablecoins in order to do that cross-border payments. We see banks, for instance, in my day-to-day work, I'm mostly speaking to banks and telcos as well as corporate institutions that are looking at intra-Africa transfers where they're utilizing stablecoins as a form of treasury management solution and cash management solution. We even have airlines that have trapped liquidity in the likes of Mozambique or Malawi that will convert their local currency into stablecoins and then pay out into Rand, for instance, let's say in their parent company. There's also remittance as well as saving products. So in terms of the volumes and in terms of where you can say the bulk of the use cases are and what we are seeing in terms of my line of work, it is cross-border payments, especially treasury management solutions, intra-Africa transfers. And then when you think about remittance as well, how do you then capture the 96 billion remittance flows as well? So you got telcos looking at their stablecoin strategy at ways in which can we do, for example, a savings product as well with yield-bearing components? So those are the use cases. And adding a little bit more texture on that, it makes sense that cross-border payments are generally the ones that are pushing up the volumes. Because if you look at the statistics and the data, so cross-border payments market currently sits at 194.6 trillion today, and it's going to grow to 320 trillion by 2032. So we know that sub-Saharan Africa is the most expensive region on earth to send money. Banks averaging 14.55% in fees. So if you have a solution, set a stable coin where you can use it for treasury management solutions, where cross-border payments as a whole is heavily fragmented, you know, the normal flow of funds where you will literally have to hold in foreign currencies, then you have your nostro-vostro accounts. It does make sense that the use cases for that is mostly going to be around the cross-border payments and intra-Africa flows.
Thank you. Just one follow-up question very quickly. Again, and let's be disciplined on the time. You've described quite a range of use cases, again, with a big emphasis on cross-border, but also US-denominated stablecoins. I think there's a brewing debate around stablecoins denominated in local currency, whether there is a market for them, where there's demand for them. What are your thoughts on that? And in 20 seconds, if you can.
20 seconds. Okay, so very, very quickly, yes, we know the answer to that. And the honest answer is that where it comes to USD dominated, stable coins, it is the reigning supreme at the moment. And there is actually the BIS annual economic report that states that around 99%, roughly 320 billion stable coin on that. I wouldn't say, in a sense, there's not a market for local stable coins. What I would say is that right now, when you look at Africa as a whole, I remember at the start where you said it is the fear of missing out. I would rather go on to the fact of the matter that as Africa is booming, as obviously one of my favorite statistics to quote is by 2050, 1 in every 4 people on earth will be African. There's going to be a rise in consumer expenditure as well. There is going to be a need to remain competitive. There is going to be a market for obviously the local currency aspect. And really the way in which I see it is dollar rails for cross-border settlement and then local currency stable coins for domestic debt. As I do have 20 seconds, what I would say is I have written an article on this and it was just published yesterday. Please take the time to look at it because when we do think about USD denominated stable coins, the elephant in the room then is on sovereignty. But there is a market where both can play.
Yeah, I think we'll come to this point on sovereignty. Abdallah, I've seen you nodding quite a lot, especially to this last to the last statements. Again, Ripple operates very much across the world. You have a global business. How does Africa compare? Where do you see the opportunities? How does the market there stand out? And yeah, again, on this point of USD versus local stable coins, what role do you see the two playing?
Yep. Thank you for having me. I'll start with the second question only because I was nodding so emphatically to what Gillian was saying. I think one thing I like to highlight always is if you take stable coins or tokenized money or crypto out of the equation, there's a simple fact we all have to contend with. 60% or something of the sort of global invoicing still happens in dollars. The issue of dollar dominance is not something that's specific to blockchain technology or specific to stable coins. This is something that we all contend with. Now, from a global perspective, I think we still see a lot of the market cap of the stablecoin market cap being in dollars, and that's for a lot of obvious reasons. What our hope is that, to Gillian's point, and that's why I was nodding emphatically, is yes, there's a role for local currency stablecoins. We see them as a net supervisory gain for regulators who are looking into how they can actually worry about monetary sovereignty with the dollar denominated stablecoins coming into the market. We see an opportunity for regulators to allow their businesses to access dollar liquidity more easily. So and Gillian touched on that. That's on the dollar and local currency stablecoin question. On the first part of the question, I think the main theme for Africa in general and stablecoins in Africa specifically is utility. What has been a big driver has been, again, in the rest of the world, we've seen stablecoins have a lot of use cases around DeFi protocols, around being used as collateral and what have you. But when it comes to the payment infrastructure in Africa, there's a big opportunity to improve in efficiencies. And stablecoins have been able to fill that gap. That's on one hand from a macro perspective. On a more sort of personal micro perspective, I think Africa's fintech leadership is translating very well into the world of stablecoins. This isn't a market where the idea of a digital wallet that sits on your phone is new. This is something that's existed since the early 2000s practically. So there's a young tech-savvy population that's just not going to put up with the fragmentation, with the fact that 12% of all intra-African payments have to leave the continent to actually go from one African country to another. So that's been the main driver, and that's been what has driven Ripple's business on the continent. I think for us, the role we see ourselves playing is as an enabler for African companies that are solving for real African problems. We're an infrastructure provider at the end of the day. There's a lot of innovators. From an RLUSD perspective, as an issuer, we're seeing a lot of uptick. From our custody product, we've partnered with banks like ABSA, who in South Africa, on custody so that they can enable more sort of access to businesses that are trying to access the efficiencies of crypto and stable coins. We work very closely with Yellow Card and Gillian's team on obviously including RLUSD on their platform, but equally on the back end on enabling a more efficient way of transferring on the ledger, transferring value on the ledger. We've been an investor in Flutterwave, but I think the closest to my heart is the work we've been able to do through our social impact side of things, which is experimenting with what financial inclusion can mean in a stablecoin world. I think we've had two successful pilots on stablecoin enabled disaster relief insurance, both in Kenya so far. The third one will hopefully be issued in Uganda this month. But the first one was for drought relief for pastoralists. The second one was working with Block Bima on insurance for informal traders when it comes to rain. On the first one, we saw a 95% reduction in settlement time, 64% reduction in cost. On the second one, similar efficiencies with 77% payouts. I think this is where it becomes more interesting when we speak about utility. Obviously, payments is a big subject, but for example, insurance has always been the purview of certain segments of society who can actually wait for that liquidity to come in, who can actually do the claims. It's not a very efficient economy for lower income members of society who have to be included financially. And what we found is by utilizing blockchain technology, we're able to to use just validators and what have you to be able to do payouts without having to go through a lengthy claim process, going down from 30 days to 1 day. So that's where we see our role in Africa, is enabling these use cases. And I'm conscious of the time frame, so I'll stop talking now.
Thank you. No, this parametric insurance example is it's very interesting, and you've done a fantastic job at taking my role away by mentioning financial inclusion, because this is the perfect segue for Ivo. So Ivo, over to you. You've spent quite a bit of time looking at the patterns of coin adoption across African markets and thinking about the risks and opportunities for financial inclusion, and also from a consumer perspective, consumer protection perspective. So what were the main insights from that research, and what are your thoughts on this debate?
Thank you, Hugo, and thanks all of the partners for organizing this event. I see pretty good attendance, a lot of friends in the audience. So this is clearly a topic of interest. So let me just start with speaking a little bit about the US denominated stablecoins, where I just reiterate what Gillian Abdallah mentioned. The use case there is clear and it's been voted for by millions of users. Is the cross-border payments, right? Be it a direct wallet-to-wallet transfers or a sandwich model where you can use stablecoins as an infrastructure effectively for cross-border payments. And the promise is that it will cut the time and cost, which is really a very high across the African continent, and especially in sub-Saharan Africa. So there's the opportunity that we see and we recognize, and we see the uptake on the ground. The risk is, however, that it will not work for the excluded and underserved customers. In other words, the risk is that we are building an alternative or parallel system for cross-border payments, but it's not going to be more inclusive. It's not going to be more inclusive alternative to the existing system that is definitely not inclusive, right? Because in Africa or elsewhere, the answer to the question whether it's going to really solve for the financial inclusion issues hinges on the on-ramps, the off-ramps, and the overall ecosystem in which stablecoins can be used. And in fact, my colleague and William Cook and the team that he leads, they have tested this hypothetical benefit in the extreme case scenario of humanitarian payments, something that Abdallah already mentioned. Asking basically the question, can stablecoins offer an alternative rails to the traditional correspondent banking that oftentimes does not reach to places under extreme distress from violence, political instability, or natural disasters? And their answer in the recently published document is that it really depends largely on the available infrastructure on the ground. So that's something that I would definitely caution against. And we need to be very careful, and hopefully we'll talk a little bit about what are the barriers that still persist on the ground that maybe prevent more people using and benefiting from financial services.
Perfect, thank you. And yeah, I think that point on the on-ramps and off-ramps is it's not very well understood, but I think we've all identified that as a major barrier. I think in part 2 of the debate, we'll turn to the regulators. So just trying to build a bridge to that, I'll just come back to the three of you and ask, what do you think is the main barrier these days to a more widespread adoption of these instruments? And when I mean adoption, is not just adoption for the sake of adoption, is adoption in the sense of utility. So using this in a way that is relevant for people. And Ivo, I'll probably start with you just to so that you can build on your thought. You were mentioning the infrastructure, the parallel infrastructure that is needed to connect to the systems. Do you want to expand on that or add another barrier?
Yeah, so this is very important question, the one that we're really focused on, the barriers. And let me start with saying that the widespread adoption, again, really means that it's an adoption that reaches financially excluded and underserved people. I have made a point before, the current financial system is not working. If it leaves 1.3 billion adults out, that means that something fundamentally is broken about that system. And so we have this unique opportunity to build something different, something potentially better. But if we talk about the barriers that we need to address to build a better, more inclusive system, they are the same as for the traditional finance. It's a lack of money. It's a lack of documentation for anti-money laundering and terrorist financing compliance. It's a lack of trust of customers. And it's the cost of infrastructure to reach customers who are living under the poverty line in extremely remote areas or areas that are disconnected, right? And so if you think about it from the stablecoin perspective or tokenized money perspective, you still have those barriers that need to be solved for those people. Otherwise, we will probably see incremental gains in financial inclusion and improvements for people who are financially included. Gillian, for example, mentioned the great use case of storage of value in highly volatile markets, where you can buy stable coins and protect your savings. That's a great thing for people who are already included. But if we really think about those 1.3 billion people, we will need to address some of those barriers on the ground, and that will require more than just adoption of the technology.
Abdullah, giving to you.
I'd like to thank Ivo for giving me an opportunity to build very nicely on what he said, but I think a main pillar of what Ivo touched upon is going to be regulatory clarity. Simply put, without more consumer protections in place, AML frameworks in place, it's going to be hard to get that sort of on-ramp, off-ramp cleared, but with the banks and with the big financial players that will effectively have to take the burden of it all. Merchant acceptance will follow regulatory clarity. So there's no discounting that the need for the impetus for regulators to get ahead of it. And I think what we've discovered often is lack of regulatory clarity has not really affected adoption. It's just created a bigger risk that meant that the most vulnerable parts of society are most affected. So in order to sort of enable that financial inclusion element, in order to enable that widespread adoption, getting a framework that works is key. Getting a framework that allows businesses to scale is also key. So, I mean, what we'd love to see more and more, which we're seeing to a certain extent, is other than collaboration between industry and regulators and policymakers, there's also collaboration between policymakers themselves across the continent in order to create opportunities for businesses to scale.
Thank you. Gillian, you opened, and I'll ask you to close this session. What is the main barrier in your view?
So they've kind of touched on a few of the main ones, really on the regulation aspect, the aspects of financial inclusion, because when you even think about stablecoin, especially the orchestration layer, how it all works, you're thinking liquidity, you are thinking of the distribution layer, how does it on and off ramp as well? So I have to really go on the cultural nuances. If we are building and we're building this right, we must build for Africa. I know it sounds cliche, but it's a point. You should be building a technology, one that works on the continent and not one that you're thinking a big pie in the sky that it works in San Francisco. And I often touch on the orchestration layer over and over again, because we talk about the settlement layer. How do you convert your local currency to stablecoin and then you off-ramp it? But what about the plumbing? How does that work in the context of Africa? So the orchestration layer is the liquidity, the compliance, your local execution, your distribution. How do you mint and burn? All of those things. You need to be thinking about it properly to understand it. And like everyone is saying here, is the way in which we do things on the continent is completely different. The aspect of financial inclusion. So therefore, when you are a developer, where you're an innovator, your orchestration layer is what is actually going to do or die. And in terms of success, where it comes to stable coins, yeah.
Thank you so much. And again, that was a very good. You're all doing the job for me. That was a very good cue for the regulators. I'll just say, I've heard you loud and clear about the points on monetary sovereignty. I just felt it was incredible of me to ask you to try to tackle that one in 20 seconds or even 1 minute. So I'll save that topic for the Q&A because I've already seen many questions around this. But yeah, just we'll come back to that one in the Q&A. Just wanted to flag it to everyone. So now we'll have a section or a part of the debate more focused on the regulators. So I'll start with Dennis from the Capital Markets Authority in Uganda. Uganda has been working on the legislation of digital assets more broadly, including stablecoins. Dennis, I know you're looking at this from obviously the capital market side of the equation. Stablecoins might come to some extent within your perimeter. I think that is a subject of discussion. Can you give us an update on where you are and through which lenses are you looking at the topics that we've just discussed?
Thank you for the question. First of all, apologies, I'm not appearing on camera because I have low bandwidth. So, but earlier on my camera was on, but I guess I have to conserve the bandwidth. So regarding the update on where we are as far as developing of our framework is, we've gone through a number of stages. We first had the regulatory impact assessment done. And as we speak now, we have the first draft of the Virtual Assets Service Providers Bill in place. In fact, next week, we are going to have a meeting to approve the bill before it goes to cabinet for approval to go to parliament. And we envisage that before end of this year, we are likely to have the virtual assets bill in place, and that will give way to the regulations to be put in place. But regarding the approach we are taking, we are doing a lot of benchmarking against other regulators, and we are adopting the approach of same activity, same risk, and same regulation approach. We think that if a tokenized instrument functions like money or payment infrastructure, it's expected to meet payment, e-money, banking, custody, and other operational resilience and customer protection standards. However, that said, we are baselining on, and this will come now in the regulations, but we have to provide the primary infrastructure within the bill. We are looking at licensing of service providers, authorization of issuers, one-to-one reserve backing, segregation of reserve assets, clear redemption rights, custody rules, governance and risk management requirements. But the nitty-gritties will ideally come in the regulations. We are also adopting a more or less conservative approach because we are cognizant of the fact that we need to manage capital flows, currency substitution risks, and also foreign exchange controls. And of course, not forgetting investor protection and the interoperability issues thereon. Thank you.
Thank you so much. I'll turn now to Tahiru from the Central Bank of Ghana. Tahiru, I know you've been working also intensely on getting out some guidance rules on stable coins. Can you give us an update on that and talk a bit about the trade-offs that you're trying to resolve? In particular, this distinction between the way you regulate any local denominated stable coins and the way you regulate USD stable coins.
All right. Thank you very much, Hugo. And thanks to the panelists for the wonderful insights so far. So Ghana, Bank of Ghana has been looking at a stablecoin framework, which is being built out of the Virtual Asset Service Providers Act. So the Virtual Asset Service Providers Act, which got enacted towards the end of last year, actually classifies stablecoins under tokenization. So we have Bank of Ghana being responsible for stablecoins. As Roman presented, which are more or less tokenized money, and whereas the Securities and Exchange Commission is responsible for tokenization of real world assets. And based on this consultation paper, which we are hoping to review with the industry in the coming weeks, we are considering a license for local issuance, which is mostly expected to be denominated in the Ghana cedi. So that is one. The other framework we are looking at is to have a framework that applies to some foreign currency denominated stablecoins, which may not necessarily be issued in Ghana, but benefit from circulation or use in Ghana. So we're going to have quite a different framework for that, because we treat them, and I think that dovetails to the second part of your question. We treat them as separate instruments. And at the center of it all, as Gillian mentioned, is the consideration of monetary sovereignty. But I will specifically say it is about the monetary system, right? What is the impact? Do they have the same impact, cedi-denominated stablecoins and USD-denominated stablecoins? Obviously, the impact is not the same. And concerns have come out about the perpetuating or the tendency to advance dollarization, even through stablecoins, for example, in emerging markets, and the consequences, the economic consequences in terms of impact or potential impact on monetary policy, how the central bank is able to continue to effectively use inflation and interest rate, inflation targeting and interest rate, to manage the economy. So whilst one can be seen as an enabler, so that is the cedi-backed stablecoin, can be seen more as an enabler of the monetary policy, because this is basically the same currency, just wrapped, exactly. So, but when you look at, the same cannot be said of foreign currency-backed stablecoins, and there is already a precedent, even in the advanced economies that we are looking at, where foreign denominated stablecoins receive different kind of treatment, especially when it comes to things like use for payment or settlement of domestic transactions and all that. So I think the way we are looking at it is that ultimately we have to be able to manage the risks of foreign currency denominated stablecoins that circulate in the economy. So that is number one. And then also to try to promote or advance Ghana cedi-backed stablecoin with the hope of encouraging or promoting innovation. So in terms of the advantages you have, so the use cases have to be clearly defined, use case boundaries, and even as we continue to pursue CBDC, central bank digital currency, we expect that all these instruments will work together with clearly defined minimum standards, perhaps use case boundaries and stuff like that. Where competition will be useful, we could look at it, provided competition is going to provide clear benefits. I think in the interest of time, I might just pause here. Thank you.
Yeah, I had many questions for you, but in the interest of time, we'll move on and we'll come back to some of this. Visham, Mauritius has issued some guidance on stablecoins very recently, building on the existing regulatory frameworks. So what is the purpose? What are you trying to achieve? What is the scope of the new guidance, and how does this link with the debate that we're just having?
Thank you, Igor. You rightly spot the issuance of the guidance note last week. Um, First of all, thank you very much and good afternoon, everyone. It's a pleasure to be part of today's discussion and join my fellow panelists. I look forward to sharing the Mauritius regulatory perspective and to a very interesting exchange. Let me take you, Igor, first of all, with respect to the evolution of the financial landscaping when it comes to virtual assets in Mauritius. In fact, Mauritius has adopted a progressive and comprehensive approach to the regulation of virtual assets, which includes as well stablecoins, which falls under the definition of virtual assets. We started by addressing specific digital asset activities, including digital asset custody in 2019. Okay. Now a major, not now, a major development then came with the enactment of the Virtual Asset Initial Token Offering Act 2021. We can call it as the VATOS Act, which came into force in February 2022 and established a dedicated regulatory and supervisory framework for virtual asset service providers and including issuers of initial token offering. Importantly, VATOS Act, when we came with this act, it is activity based. Okay, it is activity based. These activities are reflected in 5 VSP license, which includes broker dealer, wallet services, custodian, advisory, and virtual asset marketplace, together with a separate registration framework for issuer initial token offering. Then the framework further supported by 8 specific VATOS rules covering capital requirements, client's disclosure, custody of client assets, cybersecurity, advertisement, risk management, statutory return, and including travel rules. Okay. Most recently, as you mentioned, the FSC has built on this framework through its guidance note on stablecoin. The guidance, in fact, the guidance note is particularly important because it set out regulatory expectation around capital and liquidity, operation risk, resilience, reserve asset, redemption, custody, and safeguarding and disclosure and independent valuation of stablecoins. For on reserve, for example, let's say the value of reserve asset must at all time equal or exceed the aggregate peg value of outstanding stablecoin. Where the reserve create additional risk, appropriate over collateralization is required, and the currency peg stablecoin, the reserve should compromise asset with a minimal market and credit risk. Okay. So our focus is not simply whether a token call itself is a stablecoin. We look at the substance of the arrangement, the activity being performed, the quality, and the liquidity reserve, including the redemption right, custody, governance, and the risk to users. And I would say that the overall stablecoin guidance does not operate in isolation. It sits on the top of already established VATOS legislation, licensing, prudential, conduct, and including AML and safety framework. Here, I would say that the key point, Mauritius has already a comprehensive regulatory architecture for virtual assets, and currently our stablecoin guidance built upon a architecture by addressing the specific risk presented by stablecoin. So I would invite viewers to go through the FSC website where you can have a comprehensive idea on the guidance note recently published. Thank you, Ingo.
Thank you so much. And you're welcome to post any documents in the chat. I think my Roman is already shared Gillian's article and some of the reports that we published.
Sure.
Yep. You're very welcome to do that for the audience. Perhaps I'll go and just trying to broach this sovereignty topic slowly. But going to Tahiro first. So Tahir, you made this very clear distinction between stablecoins denominated in local currency, which will be subject to regulation around the issuance. So that's your current thinking. And then for USD stablecoins, which will be regulated in a different way. You might not regulate the activity of issuance, as you said, but you would still regulate the use in some shape or form, taking into account the use cases. I'm now trying to link this back to the conversation we had earlier with Gillian, with Ivo, with Abdullah. If these USD stablecoins are so important for cross-border trade and for cross-border transactions, to what extent are you comfortable with that use case, and what mitigants or what measures might you be putting in place to mitigate any of the risks that you see to your, basically monetary autonomy? Are you thinking of applying capital controls? Is this going to be done through the exchanges, through the CASPs, or how are you going to do this in practice? How are you going to deal with the USD ones?
Yeah. Oh, thank you very much, Hugo. So I think it is, as we will normally like to put it, is basically the idea is not to stifle innovation, especially where you see clear benefits to the public or to the citizens, but to make sure that the inherent risks are properly or adequately contained. So our approach is to make sure that we have a kind of monetary architecture where different instruments might play different roles. So far as we are able to work with the industry to advance fit for purpose regulatory frameworks, or to be able to profile, to be able to provide sufficient safeguards around these use cases, I think that it is something that will be permitted within our framework. And so particularly when you are looking at USD-backed stablecoins, I think the use case may have to be more focused on cross-border payment, on remittances. And even as we conduct our policy sandbox presently, these are some of the use cases that we are observing within the sandbox, and we are hoping that even in practice, this is what is going to be rolled out.
Okay, perfect. A true politician in your response, I'd say. But I think it's very clear that for domestic payments, it raises a lot of issues, and that you're trying to mitigate and reduce those risks as much as possible. But then again, linking back to the conversation that we were having at the start, at the cross-border level, they do play a very important role, and you need to accommodate that to some extent. I think that is the gist, and that is where we see, I think, most jurisdictions, the balance that most advanced jurisdictions are trying to strike. Dennis, let me come back to you just with a question about the way you are thinking about regulating the CASPs that handle these stable coins. Because as I said, the CMA might not regulate the instrument per se, since it's capital markets, but you would have some competencies specifically on the CASPs. Will there be any specific rules on how they would handle stable coins or digital assets backed by monetary instruments? What is your thinking on that, and how early would this come in your framework? Because you're going to develop this in stages, from what I understand. So how much is this a priority to you?
Thanks for the question, Hugo. Yeah, like you rightly said, we are not going to be directly regulating tokenizations or tokenize the assets. But if you look at the ecosystem, the entire chain of the issuance activity, CMA, as Capital Markets Authority of Uganda, we would be interested in looking at the underlying, the pegging of the tokens issued. So those assets, when you look at our financial markets depth, what we have right now, we are likely to have most of those assets consisted of government paper. So, and government paper is clearly under the ambit. Secondary trading of government paper is clearly under Capital Markets Authority. So that's where we come in. The investment of those assets, that's where we will be concerned, and and having envisaged that, we are working with the central bank to have a common sandbox where we can be testing together in the same sandbox. We can be testing innovations so that we can have kind of a joint effort on managing the issuance of stable coins in Uganda. I don't know whether I have responded clearly to your question.
You did very clearly. Thank you so much. So in the interest of time, we're going to move to the third and final part before I open then the floor, or I'll take a few questions from the chat. In here, we'll focus on the case for regulatory alignment and regional integration, which is actually one of the main drivers or motivations for promoting the debate. And I'll go to Gillian and Abdullah first, I think with the same question, again, so that we save a bit of time there. What do you think are the practical steps that would most accelerate progress in the scaling of this cross-border activity using these instruments? And we're thinking in terms of industry partnerships, joint research, common standards, or interoperable infrastructure, which I think some of you have mentioned already. Which do you think are the practical steps that would be most needed to address the barriers that we've talked about earlier? Gillian, perhaps we start with you.
Okay, no problem. So for me, from industry partnerships, one of the things that we spoke about with all our discussions there, our platform, obviously, from a regulatory point of view, it is when we're thinking about the distribution, when we're thinking about financial inclusion. I've spoken about on my day-to-day, I'm working with banks and telcos building out their stablecoin strategy. Where it comes to telcos, you cannot think about Africa, its distribution and financial innovation without thinking about the telcos. So if you take, for example, MTN, that has about 312.7 million subscribers. And if, for example, a telco such as this is looking at ways to embed stablecoins solutions into its offering in the likes of a savings product where obviously its customers will be able to add yield from there. That is also opening up the floodgates in terms of bringing stablecoins in. From a regulation point of view, we spoke about obviously the aspect of cultural nuances, but more importantly, regulation must become clearer and more internationally coordinated. For example, you have institutions that need certainty regarding who can issue stablecoins, the quality and custody of reserves, redemption rights. Then you have financial crime controls, bankruptcy treatment, and the responsibilities of intermediaries. We do need to have an understanding across the many different countries within the ecosystem. There is also something that you've seen recently across many of the markets where it's about the taxonomy. We've recently seen some changes in Nigeria as well as Kenya. So right now, regulators are using different words for the same activity and the same word for generate different activities, issuing a stablecoin, holding custody, running an exchange. We do need some uniformity there. So these are just a few things. For me, it is the partnerships, the telcos, the banks in terms of distribution. I looked at Airtel, I looked at MTN, we look at Airtel in terms of the subscriber base as well, what products, how they bring in stable coins, even look at the banks as well within the many African countries, the likes of, let's say Access Bank, Standard Bank, their customer base. Let's say they are utilizing stable coins where it is for treasury management solutions as well as cash management solutions. What does that look like? But regulatory clarity across our borders is quite critical as well in order for us to continue to move and grow when it comes to stablecoin traction in Africa.
Thanks so much. Abdullah, do you want to come in on this one?
I'd open with agreeing with Gillian on a lot of what she said. And I think, collaboration with industry is key. And to build on something that Gillian touched upon in the first theme, in the first part of today, benchmarking is important from a regulatory perspective, but listening to industry in Africa that has solved for African problems historically is also very important. I think we've seen the European market, the British market, the American market are very different than the African than certain African jurisdictions. And yes, it's important to benchmark, but it's also very important to listen to industry that has solved for real problems on the ground that African markets face. And we're seeing this play out in real life. South Africa and Kenya have issued extensive consultations. Ghana is currently, and you can speak to this a lot better than I could, going through an extensive sort of education piece across the entire country on crypto and stables and what have you. That is quite frankly admirable. We've seen Nigeria open up the sandboxes. Mauritius has its own guideline now that was in consultation for 2 years that a lot of industry got to respond to. But this is the key to having a national agenda, national priorities and national agendas that work for these jurisdictions. And then the second step is obviously scaling that. So we see more collaboration between these jurisdictions. We've seen this play out. Rwanda has now some form of agreement with Ghana and with Kenya. We'd love to see more of that. We know that the Africa Fintech Network is working on an initiative at the moment that actually is looking at what passporting could look like across the African continent. That's on the sort of a bigger level. I think from a pilot perspective, there's something we've all touched upon, regulators and industry today, which is how will we call them foreign stablecoins, but let's be honest, it's denominated stablecoins interact with local currency stablecoins. Pilots that address this early on are going to be key. There's a fact we can all agree on. Yes, there has to be some level of, I don't want to call it protection, but some level of securing the local rail payment infrastructures for local stablecoins, so that, touching on what Tahiru talked about, the central bank can still control its policies and be able to influence the market. But equally, how does that interplay work with these dollar-denominated stablecoins to reflect what we see today? The market cap right now is at what, 95% plus in dollars. As when it comes to stablecoins, it should reflect the current FX market. It's still going to be majority in dollars, but let's have more local currency stablecoins that are in play there. And from our perspective, we think that it offers a lot of transparency for the regulator to be able to adjust to the actual dollars in circulation. There's a lot more visibility. There's a lot of more on-chain analytics tools and supervisory gains that can be benefited from. But if we're being honest, no one has the answer yet, especially in emerging markets. What this requires is pilots that reconsider how this supervision will happen, how these adjustments will happen. And yeah, I'm not going to pretend we have a straightforward answer, but hopefully as we see more of these pilots address this question, it's going to be key. And then finally, I'm always self-critical. I think it's up to industry to be very transparent with regulators. It's operating, and let's be honest, the crypto industry has had some bad players in the past. None of them are here, but it's very key that industry sits in front of the regulator, has a very transparent conversation about what just quite frankly, what the liquidity looks like, what the flows look like, what the volumes look like, so that the regulator can have a good idea of how they want to regulate. And then we can all achieve what we want at the end of the day, which is regulation that sponsors adoption, but equally does not stifle innovation. The golden balance, if I may.
Thanks so much. I'll now turn to the three regulators, and very briefly, what you see as the main mechanisms of collaboration and alignment, or the ones with the greatest potential. Tahiru, I think there was this recent agreement between Ghana and Rwanda on the sandbox. I hope I'm not mixing anything up. Is that a model that you want to replicate with others? Do you see that as a model for others in the continent? Yeah, we'll start with you, and then I'll go to Visham and close with Dennis before concluding the debate with you.
Yeah, absolutely. That is the Fintech license passporting framework or arrangement Bank of Ghana established with the National Bank of Rwanda. And it is actually, the vision is to scale, the framework in order to have a lot of other countries as much as would be possible to come on board. So we believe that this is an early model, that can contribute to that level of regulatory collaboration we need in the evolving fintech and specifically the virtual asset sector. But I think as globally, we need to come to a certain consensus or a certain compromise. So, a lot of us are developing separate frameworks, fragmented. I mean, you can look at the advanced market, the Genius Act, the MICA, and there is no mutual recognition or what is known as equivalence recognition. So the fact that you are licensed in US does not necessarily, guarantee you any passporting credit whatsoever when you go to another market, the EU, for example. And I think that even whilst US, the Genius Act tries to resolve this issue by signaling some kind of mutual recognition arrangements. But when you look at the terms that come with it, I sincerely think that it's not going to benefit emerging, or it's not going to treat emerging economies like Ghana fairly, where we have instruments backed by foreign US dollar, for example, widely in circulation. And I think that perhaps the standard setting bodies and working with the industry and fellow regulators, we have to be able to have some level of coordination. Otherwise, everybody is just going to ring fence or adopt this protectionist approach that you minimize foreign currency backed stablecoins in your space as much as you are capable of doing. Thank you.
Thank you. Visham, mechanisms of collaboration. Where do you see the greatest potential? And what have you been working on? I think you're muted. Sorry.
Sorry, Hugo. You can hear me?
Yes, I can.
Fine.
I can
Yeah,
hear
what
you.
I mentioned earlier is that I certainly see the value of closer regulatory collaboration across Africa. Okay, but it is important to make a clear distinction between alignment and identical regulations. We do not necessarily need every African jurisdiction to adopt exactly the same legislation. What would be more valuable is greater convergence around common regulatory outcome and a minimum standard. I see several areas where this could particularly be useful. Let's say, for example, the common terminology and taxonomy. Second, I would say that it would work toward the common minimum safeguard when it comes to stablecoin and virtual assets. Okay, there is also the considerable scope of greater ML and interoperability, particularly around the practical implementation of the travel rules. Okay. Fourth, when it comes to regulator, as a regulator needs to be strong, needs strong mechanism for supervisory information sharing. Let's, for example, if the same stablecoin provider operate in several African jurisdictions, regulators should be able to exchange relevant information about the risk, the incidents, regulatory concern. And lastly, I would say that there is strong cases of our joint regulatory pilots or interconnected sandbox. Instead of discussing cross industry, could select one or two genuine African payment corridor and test them under a coordinated regulatory oversight. Okay. When it comes to a question like what about mutual recognition or passporting, like my colleague said, I would be somewhat cautious about moving immediately to a licensing passport. Okay, mutual recognition requires regulator to trust not only the other legislation but also each other supervisory implementation and enforcement elements as well. So I would see passporting as a possible later stage of regulatory integration rather than starting point. A practical sequence could therefore be we go for mapping with the common principles, information sharing, cross-border pilots, and a possible mutual recognition. Here, my key, to conclude, my key message would be, before we passport license, we need confidence in each other's regulatory and supervisory outcome. Okay, this is on my part.
Thank you so much. Dennis, you have a final word on this one before then I go to Ivo to close the discussion.
Thank you, and I would like to take this moment to thank my counterparts for the submissions they have made around collaboration. But just maybe to comment on passporting, it's a good initiative, and it will help solve so many bottlenecks, but we need to align across regulators, maybe regionally, and maybe if possible at a global scale, on at least the minimum standards when it comes to licensing and market conduct aspects. That way, if we can achieve that alignment, then passporting will be able to happen. But also to add on to the initiatives that we can undertake, one is we need to think about creating or undertaking joint supervisory colleges for those firms that operate in multiple jurisdictions or multiple countries. My colleague has also talked about the multi-country sandboxes or pilot programs where we can come together as regulators to study innovations that are in a common sandbox as opposed to a CASIP going to each jurisdiction submitting applications to be allowed to enter into the sandbox. We should also think about setting minimum standards. This I talked about it, but just for emphasis, minimum standards for transparency, accountability, risk management, and the other aspects of market conduct, because I think this would reduce fragmentation and also lower the cost of responsible innovation for the CASIPs.
Thank you so much. Ivo, I'll turn to you to close. Obviously, as researchers, I think we have a role to play in supporting the development of policies and informing discussions on market development. Where do you see what do you think should be the priorities in terms for our research agenda?
Thank you, Hugo. So I think the priorities are very clear. We need more data, more accurate data on the whole tokenized money ecosystem. The Cambridge Center has been doing a great job and some other outlets, but I think we need more of the understanding of the use cases, the uptake, and the people using the tokenized money and stablecoins, and have some specific evidence about the benefits of stablecoins. So I think that's a really great area for research. My colleagues have mentioned passporting as a great opportunity. So I think there is a lot that can be done in sort of quantifying that opportunity, what it means in practical terms, not only mapping out the regulatory efforts that are needed, but also what would be the impact for the fintech industry, for the capacity to scale, but also for the customers, notably the micro and small entrepreneurs who are already operating cross-border, how this can affect them. So that's one specific area where, again, researchers can be very useful. And then the last one that I kind of mentioned is looking at opportunities beyond what we have discussed. I think there's a one right there with seeking the designation of supranational jurisdiction by FATF, the Financial Action Task Force, which is an international standard setting body that decides AML/CFT rules, allows multiple countries to operate as a single payments market. And if they do, that reduces the compliance cost and has positive benefits for the speed and cost of transactions. Currently, there is only one single such designated jurisdiction, which is the European one. But I see multiple markets in Africa that could potentially qualify, the existing monetary and trade unions across the continent. And I think that's one opportunity, again, that is right there where researchers can help to understand what exactly are the qualifying criteria that those regions would need to meet to qualify as that supranational jurisdiction and benefit from that. So let me stop here.
Thank you so much. We have 6 minutes left before closing before the top of the hour. There are, I don't know, more than 20 questions, more than I managed to read. I think we've touched upon some of the questions that you've asked. So issues around how should regulators deal with USD stablecoins? To what extent do you need to localize the reserves? I think we might not have covered that directly, but we've touched upon those topics. There are a couple of questions that I found very interesting because they're very specific to the African continent. There's one in particular asking about how stable coins will compete with other money instruments, or will they be differentiated? Actually, there's a few questions on this. There's one that asks about tokenized deposits and how we delineate. There's another one that asks for the role of stable coins in competition with mobile money, which is one of the big success stories in Africa. So I'll just go to the panelists, or just invite for a couple of volunteers among the panelists to think about this. What is the role of stablecoins in competition with other payment instruments, tokenized payment instruments potentially? And then we'll close with some closing remarks by Patrick from the African Fintech Association. So who volunteers? Stablecoins and mobile money, stablecoins and tokenized bank money. Where do they fit? How do they compete?
I'll be very brief, Hugo, but I think we've gotten this question in different formats before. How do stablecoins compete with CBDCs? How do stablecoins compete with tokenized money? And mobile money, obviously in Africa, is a prevalent one. I don't think it's competition per se as much as it is enablement. I think mobile money will have its utility, as with local currency stablecoins. The idea is they would all work together, but there's something that Roman mentioned in his presentation on the report, which is programmability. I think what coins bring to the table is a level of programmability that we cannot see with similar instruments in the past, that will be able to enable more efficiency, more transparency, and what have you.
Thank you so much. Anyone else?
Okay, so just to add a bit on that, I agree with Abdallah that it is supposed to play more of a complementary role. There could be situations that competition may be permitted if it is going to lead to real benefit. So, in the domestic transactions, there could still be one efficiency here and there. If stablecoin properly regulated and denominated in Ghana cedi is going to be able to provide, competitive benefits. Why not? So that may be permitted, in that sense, maybe for domestic transactions where it is able to compete. I'm using the word advisedly with mobile money and perhaps bank deposit and all that. I'm sure it can lead to some benefits for the consumers. Otherwise, they also complement very nicely when it comes to off-ramping and on-ramping, for example. So all these benefits associated with cross-border payments using stablecoins can be maximized if it is complemented with instant payments in the domestic front. Otherwise, you risk reintroducing some of the frictions back to the value chain, and the benefit will not necessarily be maximized.
Thank you. Jillian, you unmuted yourself. Do you want to come in to close?
Yes, I think for me, when it comes to mobile money, I do not see it as competition. I see it that it complements, because remember what I said in terms of you need to think about the whole chain in terms of the orchestration layer. And with Africa, you cannot ignore the telcos when it comes to distribution. So that is why they are also building out their stablecoin strategy, and they're thinking, how do I now embed stablecoins and how do I now offer that? Now, let's also think about remittance flows. There are some telcos that are looking at inwards remittance and utilizing stablecoins for that. So it doesn't compete, it actually complements. And also, a lot of the time, and when we talk about stablecoins, we talk about the big numbers and we talk about it with excitement, but there's a number of things that I've heard on this panel, which is it actually tackling financial inclusion? Or is stablecoins actually for a certain amount of people that have accessibility to those apps and the corporate institutions? I like to think that if we are going to hit what Standard Chartered is saying about that 2 trillion in 2028, or Citigroup in 4 trillion in 2030, where it comes to Africa, these are the things that we need to do. For example, our telco partnerships, embedding stablecoins in there in order to hit those numbers. And that's it.
Thank you so much. So, Patrick, you'll save me from the trouble of summarizing this and give us some closing remarks. Over to you.
Yeah, well, not to summarize, Distinguished participants, panelists, partners, and colleagues, as we bring this conversation to a close, I want to thank each of you for the depth and candor you've brought to today's discussions. What we have had over the last 90 minutes or so is not a theoretical exercise. We have listened and felt a live map of the choices facing regulators, innovators, financial institutions across our continent right now. As tokenized money and stablecoins move from the margins of policy debate into the center of Africa's financial infrastructure planning, I want to extend, on behalf of the African Fintech Network, our sincere appreciation to our co-convening partners, United Nations Economic Commission for Africa, Financial Innovation for Impact, and the Cambridge Center for Alternative Finance. Partnerships of this nature are exactly what World Fintech Day should stand for, not just celebration for its own sake, but the deliberate work of bringing multilateral institutions, academic rigor, industry practice into the same room. To our panelists, Gillian, Abdallah, Ivo, Tahiru, Denise, and Visham, thank you for speaking with the honesty that this subject demands. You did not give us a single tidy answer on how Africa should approach stablecoins and tokenized money, but that is precisely the point. What has emerged instead is a shared recognition of the terrain, that regulatory approaches will need to be as diverse as our markets, that stablecoin adoption is already outpacing formal frameworks in several jurisdictions, and that local currency innovation and cross-border settlement are not necessarily competing priorities, but complementary ones. I also want to thank Hugo and Roman for the clarity and rigor that you have brought to moderating a conversation of this nature that could have simply become too abstract. You've kept it grounded in the practical questions our institutions must answer. A few threads from today deserve to travel beyond this call. Foremost, the AFCFTA Digital Trade Protocol has not been mentioned per se, as a backdrop to this conversation. But it's important to mention that this is a framework within which every choice about tokenized settlement and cross-border payment in Africa will ultimately have to fit in. Second, the experience shared from Mauritius, Ghana, Uganda, and across our regulatory and industry panels confirms what we at the AFN keep arguing about, that Africa does not need to import a single global template for digital assets. What we need is coordinated, interoperable national frameworks that speak to one another, which is precisely the kind of policy harmonization work that we continue to convey. There have been a lot of comments around license passporting, about single payment area, multi-country regional sandboxes. These are all the works that African Fintech Network is actually convening and championing. Thirdly, I think another critical thread is the fact that inclusion must remain the test we apply to every innovation in the space. A tokenized financial system that does not extend reach and reduce costs for the ordinary saver, trade, and small businesses across Africa will have missed the point of building it in the first place. It has become clear today that every question before us we have not answered every question before us today. And that is exactly one of the outcomes. The gaps that have surfaced in this discussion, particularly around comparative regulatory treatment of stablecoins, the practical mechanics of cross-border settlement at scale, and the evidence base for tokenized money's impact on financial inclusion, are precisely the kind of open question that deserve more than a single session can offer. We will be taking these gaps forward as a structured deep dive research agenda alongside our partners UNECA, FI, and CCAF to build evidence and policy analysis that is needed to move this conversation from dialogue to actionable guidance to our members and regulators across the continent. To everyone joining us or who has joined us today, policymakers, regulators, fintech leaders, researchers, development partners, your presence here itself is a form of commitment. We will continue working with our co-conveners and with our national association members across the continent to translate today's dialogue into concrete regulatory guidance and cross-border pilots. World Fintech Day, which is actually August 1, is a moment to mark progress, but more importantly, is a moment to recommit to the broader, longer work of building financial systems that serve all Africans. On behalf of the African Fintech Network, thank you for being part of the work today. Please stay engaged. We look forward to continue this conversation with you. Thank you all, and have a good day.
Thanks so much.
Thank you very much. Thank you.
Thank you. Bye.
Thank you, everyone, and have a great day.
Thanks all. Bye-bye.